It's good to see you still here. I'm literally the speaker between the door and your beverages, so I can see the eyes already saying you've got to be quick, so I'll be quick. My name's Llew Jury. I don't know a lot of you, but there is some familiar faces in the room, and I'm here today to, I suppose, share Matt's wonderful wisdom about the venture capital space. Matt is a big supporter, and like him, we back in some amazing companies and founders that want to go global. In fact, we've got a portfolio company together called Submarine, and Matt's place is very important, just like your place in the ecosystem. A lot of you are angels, wholesale, high net worth, your family offices, you might be PE, and everybody has their place in this ecosystem. And I wanted to just take you through a bit of where we all locate, and it's all part of this ecosystem. And Matt gave money to Submarine, to Gavin Ballard, and then we came in the next round and supported him with a number of other investors. And then we'll all share in the spoils, as we were talking about in the foyer, now that Gavin is going global. And that's what it's all about. We're all in this together. So a bit about the Sprint team. I've actually done 2 exits. So when you're in the VC space, yes, certainly we want 100x. We're not all bad. We're not going to chop people off at the knees. And I'm here today to talk about social capital, not about financial capital. Matt's about financial capital, obviously. We're about social capital, and we're about the heavy lifting that goes on with startups. In our ecosystem, we built Sprint to be founders first. And founders first is all about giving that leg up, that hand up, to the truly generational founders that are going to move the needle and build a better future. So our motto is founders first that build a better future, and that's how we invest in the 18 companies to date across the 20 million that we've raised, and we're raising another fund you'll be interested in towards the end of this year, which is going to be a $30 million fund. So in VC, you either come from the startup or the software space. I'm an entrepreneur. I've done 2 exits myself. I've had hundreds of staff in many, many countries, and I've done those exits. And I call that the T-shirts. Or you come from the suits. And people like Professor Michael Drew, you might be aware of. He was the Chief Investment Officer of the Meyer family. He advises some of the largest family offices in the country, together with Dr. Adam Walk, who's the chair of Rest Super's governance committee. And a little bit of a point of difference about Sprint and how we've built our venture capital firm. We actually have what's called governance. And we have this thing called governance and risk. And we have a governance, risk and compliance committee that sits above our investment committee and actually handles the asset allocation of our behaviours and what we do within the ecosystem. And it's been cleared up. And I should actually say we're under the AFSL of Boutique, which is based here. So this is general advice only, and past performance is not an indicator of future performance. So just getting that out there, and please record that so I'm compliant. So some really good people on board, led by our managing partner, Georgia Barkell. So here's our investments, and we're about portfolio theory. We're about de-risking. We're not about that systematic risk or that market risk that kicks in when you guys do deal by deal. And I believe that portfolio theory is more important than ever in the current times. I actually dusted a year's worth of school fees in 2015 in an HR tech company that actually got me into this. And the reason why I'm here is because I dusted the 25K at the time, and I owned 1.2% of that company. And that company went bust within 6 months. And what it taught me, though, was that's a year's worth of my kids' school fees, and I need to actually de-risk this and actually put in place a portfolio of companies and not do this systematic piece where at the markets level, and if there's risk, there's going to be problems. And so, of course, like Matt said, companies are going to fail. But if you're in a family office, you're an investor that's going deal by deal, and you've got a couple in your portfolio, and you've put all your eggs in that basket and not spread that risk, then you could come unstuck and lose quite a bit of money. Unlike Matt's super fund with the 0 shares, which is an amazing story. I love that. So what we've done was we've built the first fund to try out this new founders first model, and we invested in companies like Koshi's Ausbiz. We invested in companies like Plaza, Umps Health, Music Health, who are really growing well, Submarine, as we said. And one of our companies actually just returned a dividend the other day. And this sovereign seed fund had checks of 200 to 300K. It closed out last year in terms of the investments in 15 companies, and it is in pre-seed and seed capital. And that proved up what we're doing, and we've already had a company returning dividends. We then had a couple of companies break out, and we decided to build the Expansion Capital Fund, which has just closed to wholesale sophisticated investors, but it's still open to instos, and there's institutional chats going on right now with that fund, and that is minimum check 500, and average check at the moment is about $1 million. And that's got companies like Paper Plane, which you might be familiar with, and UPay, Clipboard here in Sydney as well, and of course Vapor. So we invest in companies across 4 disciplines. And we invest them across the life cycle, of the funding continuum. And as you know, as I said at the start, we're all in this together. We need you, we need Matt, we need the 5V capitals, we need the perennials, we need everybody after us, but we sit in that sort of middle ground. And VC is very important when it's truly active capital management, not just handing over financial checks. It's the experiential capital, the social capital, the network capital that all of you can provide as well. And all 75 of our LPs and investors are actually rolling the sleeves up and sit on the advisory boards and want to be part of that active capital. And so we sit just before the revenue generating stage of the life cycle. That could be pre-revenue, that could be that revenue, that pre-seed, seed sort of stage, and then the scaling up stages of the latter stage seed and the Series A. We generally drop out about Series B. We invest in 4 swim lanes, and that was a great point that Matt raised, and someone else raised it as well. Stick to your knitting. When we sat down and set up Sprint 4 years ago, we didn't want to go off-piste and invest in NFT sneakers or table ordering QR codes or things that we just didn't have any experience with. So we invest in AI and automation, which is a key pillar of what I've done for the last 15 years. Health and ageing, which is Heath. Property and energy and infrastructure, which is Ben. And finance and e-commerce, which is me and one of the other silent partners. And we stick to those 4 swim lanes. And 2 of them actually are post-Royal Commission. Financial Services Royal Commission and the Aged Care Royal Commission. And we've made investments in deep thematic areas that are important to the sovereignty of Australia and important to all of us moving forward. But we believe the alpha comes from the founders. We believe if you surround founders with great social capital, network capital, your experiential capital, our LP's experiential capital, they're actually going to provide that ultimate alpha towards the success and the return. And I think that's really important. And the other piece to that is building up trust. Building up trust that we're actually going to be there through those hard times. And we're in those hard times right now. We're having those conversations at the board levels about paring back. And everybody should be doing that. We should be actually reorganising and re-energising what we're doing and the directions we're going in. And the prudent companies have already done that. They've been on that pathway for the last 12 months. So there was another question. There was another statement about deal flow. And the funnel is really important. A lot of family offices that we meet, what they do often is sort of grab a young lady or a young fella straight out of uni who basically becomes their VC desk in their family office, and they put them into the desk and say, go out there and get us some VC investments. And unless you're plugged into the ecosystem, like we've been for the last 15 years as mentors to the places like River City Labs with Steve Baxter, to doing a lot of the nights at Stone and Chalk here in Sydney, to sitting on a lot of the StartMate pieces, the remarkable things that are going to be happening tomorrow. We're mentors for a lot of these places. Unless you're plugged into all of those accelerators, incubators and startup system enablers, it's very hard to find those early deals. But when I say deals, I'm actually talking about the founders. Because you actually meet the founders 2 to 3 years before they actually set up the successful companies. And even if they set up a great company, they might actually pivot and go into something completely different. And that's really cool. We don't mind change at that early stage. But what we want to know is those truly great founders have the resilience and the grit to actually make it. And so we bring them through that funnel. And the ones that get to the bottom, we invest in 1 in 100. The ones that actually get to the bottom of those investments have been through that process with us and actually gone through, it's a bit like dating. They've gone through those hard times, those easier times, the coffee catch-ups, the lunches, the meeting the LPs, put in front of other founders within our network. And really what they're doing is proving that they actually have the stamina, like an entrepreneur who can, get through the 10 years of building a business does as well. So really important, finding those unique investment opportunities and then bringing them through an investment process. Now, buy, hold, sell, we all know that, 101. We call it acquire, mentor, value realization. And that's probably a better way in our world to distinguish that investment process. So pre-investment, we're doing a lot of the sourcing of those opportunities, as I mentioned. You're doing a lot of initial DD on the founder, their behaviours. We do a lot of psychometric testing. We do a lot of behavioural testing. We use HR, if you want to call it that, within those founders. And a lot of direct investors that are trying to find these deals direct just don't have that capability and that wide network. The other piece we do is we have consultants that go in and do audits on their AI. There was an article today about that Metagy. If you've been following it in the AFR, the CFOs come out and said actually they weren't doing AI. They were doing sort of a different, just a basic 20-year-old form of calling up and querying. So there's, AI is a good one. A lot of these startups that you're looking to invest in actually truly doing artificial intelligence, or are they actually doing machine learning, or are they doing just a chat GPT? So really interesting. We then go into actually closing out the deal. And then number 6 there, the next level value creation kicks in. And that's that mentoring. To get to value realization, you actually need to have deep mentoring. You need to actually roll your sleeves up. And look, that's a key thing for everybody. Even if you don't invest in VC funds, it doesn't matter. You actually need to roll your sleeves up in these times on all your investments and really help them out. A lot of you sitting in the room are very successful. A lot of you sitting in the room have been through it. There's a lot of grey hair and no hair like me. And so I think that, take that active management and dive in, because you're going to get better alpha and financial value realization from it. So the different forms of capital really quickly. Capital is really important. As I said, it's not financial capital. Financial capital should be the last on your list. The check should be the last thing. It's the first thing in, but it should be about the experiential capital that you bring, as I said. It should be about the social capital in your networks that you can introduce them to. Give them their first customer. That's really, really important. And I've got some examples here. And then, of course, it's about that human capital and that real opportunity to sit as an advisor on their boards and create governance and things like that. But what I wanted to really quickly show you is some of the direct things we do for some of the founders right now. And we use innovation science. And this is like, you probably think, VC funds, they kick back, they take their 2% a year and off they go, just waiting for their 2 and 20, their 20% return. And, they go off to lunch, in their big yachts and all their planes. I haven't been paid for 4 years, by the way. We don't take a wage. We're on performance. So you'd be pleasantly surprised. What we do is we go in with the strategizer models from Switzerland and actually do innovation science. And we come in and we do complete test and learns, and we use these sort of models here to actually build, measure, learn on different stages within the business. And I think that's really important, that you constantly iterate, you constantly innovate within these companies. It's not just casting the founder out. You want to actually interrogate, especially in these times, whether actually they're on the right track and use innovation science with their hypothesis to see whether the desirability, the feasibility and the viability of the business models is actually there. So you can see how deep we go, and this is all for free. We don't charge a cent, because this is what truly is active capital management. And these are some of the processes, as I said, that we use, the human-centered design approaches, the culture of prototyping, and we introduce these behaviours within the startups. The other thing we do is we hack business models, and we actually say the model you go in with might actually not be the model that you come out with. There might be a freemium model, there might be a rent instead of the buy model, there might be subscription models, things like that. There's all these different models that come up, and we actually then do some test and learns and build, measure, learns on those as well. We've got 1 minute left, so I want to give you a couple of quick case studies of actually the benefit of true active management from a venture capital firm. Halo is one of our companies from Melbourne. They're in our Care Factor Aged Care Accelerator that we ran in 2019. They won it for Australia, and we invested a check alongside Social Ventures Australia into Halo. We actually introduced them into the CEO of Anglicare Southern Queensland, and they picked up a very large contract this year through that direct link, that network capital through our former chairman. Paper Plane Simone, chair of FinTech Australia, is just jumping on a plane with her 4 kids. And basically, we've been providing the opportunities because one of our directors set up Tritium and got them domiciled as a Delaware C Corp before they did their listing, and they're the electric chargers. So we're an investor alongside QIC, MasterCard and Cusco. We're the only VC fund in the last round because of that social capital that we can unlock. And that's helped them scale into New York. Health out of Melbourne, This is AI for falls technology. Adam, one of the really great founders, I interviewed a future CEO this January in London. I happened to be in London, but I did a side trip to go and actually meet and introduce and really work out whether this person who will become the UK CEO was the right person. So really, going off away from my family, from my holiday, to head to London and meet him in the Strand to actually, really work out whether this is going to be the right person, and it was. And the final one is UPay. I'm on the board of UPay, and we built the governance function for UPay and helped them scale into the US. But we got Deanne Kettler on our board, who was Australia Post. She's now Tyro. And we also got Amanda Beard, the sister of Simon, who's the founder of Culture Kings, who is also an investor in UPay. And these are little companies that are out of their bedrooms and things like that we're scaling globally just through our connections and what we do. And I just wanted to highlight a few things. And I'm sure there's a lot of people in the room that can do the same through their investments and their scale opportunity. So that, in summary, go to sprint.vc. We're raising our third fund at the end of the year, another seed, Series A and growth fund. And yeah, I'll be out for a beer and look forward to catching up. Thank you very much.